Welcome back. Still tuned into Halftime Report on CNBC-TV18. And let's start the segment with a corporate interaction now. SJS Enterprises is on our radar. Company is one of the leading players in the Indian decorative aesthetics industry. They reported a decent performance in Q2 as the revenue and EBITDA saw growth, while margins also expanded, aided by lower raw material costs and operational efficiencies as well. Sanjay Thapar, ED and CEO at the company, is joining us now to discuss the business outlook and demand trends as well. Mr. Thapar, good afternoon. Thanks a lot for joining us. Well, Q2 has been strong. You have maintained your FY23 revenue guidance, growth guidance of 25%, profit growth guidance of 30%. But in Q2, you did win a lot of new orders and a lot of new clients as well. I was going through the list: Skoda Auto, Volkswagen India for chrome plating. There is Atomberg Technologies. You've gotten new orders as well from big auto names in the country. Will you like to revise it upwards, your revenue guidance? And if not, will these new orders and new clients start contributing from FY24 for you?
That is right. So we've got strong order intake from our customers, as well as added new customers, added new segments. So things are going as per plan at SJS, and we add to differentiation of the product. So there are newer technologies that we are incubating. So we see moving forward growth to be a strong growth, and we are confident of meeting a growth trajectory that we've guided the market to. So 25% growth is what we are looking at annually moving forward at SJS, thanks to the new technologies we have and the customer traction that we have for all the existing products as well as new technologies.
So, Mr. Thapar, 25% is for FY23. The new clients that you've added and the new orders that you won that I'm talking about, in FY24, what kind of addition will it do to your revenues? Will growth be faster than 25% then?
No, so typically we'd like to stay with that guidance of 25%. All businesses start small. So these are large customers. Businesses with them are not just in India and overseas markets as well. So it helps us to move that momentum forward in terms of growth. Essentially, we like to stay with that guidance of 25% that we've talked about.
Okay. Mr. Thapar, you know, Q2, while it was strong on a Q-on-Q basis for you in terms of exports, you did mention that your export business was impacted by around 20 to 25%. What is the picture currently in terms of your exports?
So the areas we export globally, so North America, Europe, Asia, so all these are the markets that we export to. So typically we see some slowdown or some macro headwinds because of inflation, rising fuel prices, consumer anxiety in North America. Europe still is impacted by the ongoing conflict in that region. So the guidance on the long term is extremely bullish because the penetration in those markets are still very small. But in the short term, yes, we are seeing an impact, but that has been more than made up by strong demand that we see with our customers in India.
Okay, so are you changing your revenue mix currently, you know, to get to that 25-30% revenue growth? How much are you getting from domestic and export currently? And what is the proportion that we can expect in the second half or the exit run rate for FY23?
So I would not like to say what is likely to happen in exports in the second half of this year. It's still wait and watch situation. But overall, what we've guided the market is that we expect to grow at about 25%. And that is a guidance that we still maintain. Of course, it's an evolving situation. We hope things will stabilize. But we have marquee customers that we supply to, and these are all leaders in their segment. So I would imagine that sooner than later.
25% growth, how much of it is coming from domestic? How much of it is coming from exports for you?
So at this moment, exports is impacted because of this conflict. So in this quarter, so 26% our revenues grew for this first half of this year compared to the last year. And exports saw a decline of about 20% or thereabouts. So I would imagine that this export demand at the moment has been compensated by domestic demand. Moving forward, it's an evolving situation. We need to watch the export market carefully.
Okay, so we'll speak to you when there is more update in the export markets. But what's happening on the other side is, you spoke about it earlier as well, that some of these assets are available at attractive valuations, and you are open to inorganic growth as well. Have you identified anything? Is there anything on your mind with respect to acquisition globally? And you have 129 crore of cash on your books. Will you be using that for acquisitions, or by the end of this year, the shareholders will get something out of it?
We are still on a high growth trajectory. We see a lot of opportunities, and I think shareholders, we are a highly profitable company. So shareholders, of course, will have to go along with the export story and the growth story that we have. So I think the rewards will be quite attractive. At the moment, in terms of acquisition targets, there are a few companies that we are targeting. We are in the process of evaluating synergies there, as I guided earlier. So the territories of interest really are North America, Europe, and even the ASEAN region. We are also open to look at good opportunities in India. The theme really is that whatever is accretive to the bottom line and in the interest of the shareholders is something that we are actively evaluating. So at the moment, there are 2-3 targets that we are evaluating. And let's see what is the result of our interactions with those companies.
Mr.
So they're
Thapar,
available at cheap valuations. So it's a good time to invest. But then we are watching to see what, how do they add to our portfolio.
What
and
is the
expand.
kitty of acquisition? Have you set aside any amount that this is how much I will invest in acquisitions?
So fundamentally, we are open. So ballpark figure is about 200 to 300 crores. So that is the size of the acquisition that we're looking at currently. And it depends on, of course, what is the target that we have, which we finalize on. Okay. But then it has to be accretive to the overall business and add to the story of being a comprehensive player in the aesthetic decorative space.
Okay.
And give us access to new customers, new markets. So those are the themes.
Okay, I just want to get back to the business part of things currently, Mr. Thapar. If you could just leave us with what's taking place in the consumer durable segment. Because while auto seems to be firing on all cylinders, there has been some impact on consumer durables. Where does that stand as of now compared to Q2, and what can you guide for in terms of that particular segment in the second half?
So we are still cautiously optimistic on the consumer durable segment. At the moment, as I said, some part of sales come from Europe and North America. And of course, we supply to OEMs in India. So the Indian demand is coming back, slowly though. But overall, I think in the long term, given the demographics of the country and the demand for consumer durables, I would say that this would come back. So at the moment, still wait and watch and see what happens in Europe to our consumer durable business. In India, we see demand coming back, or green shoots really happening. So, but this is more than compensated by the automotive or robust automotive demand. So that compensates for that.
Okay, Mr. Thapar, it was a pleasure speaking with you. Thank you so much for joining us, telling us what the plans of the company are and the outlook on demand as well. That's the update on SJS Enterprises. It's time for a break now. Manish Hathiramani of Deen Dayal Investments will join